Hello everyone, this is Mark from Trade Pro Academy, and in this weekend's video we're going to dive into the weekly open strategy, which is a great little additional confluence tool that you guys can use to plan for the week ahead, especially if you have a bias for the week but you don't really know where you're going to get in. This is a great tool for that. So grab a coffee and let's get at it. All right, Trade Pro. So let's just jump onto Paint quickly here before demonstrating how to use this strategy so that I can explain the concept behind the weekly open. So let's open up Paint here and let's give you an example of what we're looking for. So we'll draw a line just down the middle here, and this is gonna decipher between bullish and bearish. So in the case where you have a bullish expectation or a bullish bias on the week, whether the previous week we saw a move down into support structure and we had a pin bar rejection, anything like that where you're expecting a bullish bias, this is a great way to use the weekly open strategy in these kinds of scenarios. So what you'll notice first is, let's say in the case where we are bulls, the weekly open will be down here. What you want to do is you will kind of want to plot that line, plot that level, and watch it throughout the week. If you have a bullish bias, what will generally happen is most candles actually look like this. In the case where it's a bullish candle, you'll have the weekly open, then you'll have an expansion. So this is the expansion that we're looking to catch, and then you might also find that we've got a wick to the upside and a wick to the downside. So in the case where you have a bullish bias on the week, you can simply use the weekly open strategy to confirm your bias and to add confluence to your bias. Let's say a market opens down here. Anything that happens below the wick is considered accumulation in the context of a bullish bias. So once you have the weekly open, anything that happens under that open, we can consider it to be accumulation. Once the price gets back above the weekly open, at this point, we're looking for the expansion phase. And that's kind of how we use this weekly open strategy, is to try to identify once the accumulation has been completed and when the market's ready to expand. If we're looking on the bearish side of things, you'll see quite the opposite. So on a bearish bar, on a bearish weekly bar, what you'll have generally is the open up here. You'll usually have wick to the upside. And let's get this candle in here. You've got the body phase. And then you've got, usually not always, a little wick to the downside here, meaning that we bit off the lows a little bit. So again, same situation. In this case, it's just bearish. You've got the weekly open right into here. Anything that happens above that weekly open, if you've got a bearish bias, that can be considered distribution. So we can be considering this as the market is doing the distribution here. And what we're trying to do is we're trying to catch that expansion. So once the market trades back below the weekly open, at that point, we can start looking to qualify shorts for the expansion, for the weekly expansion. So situations where this works really, really well is when you've got a nice range and you've got a reversal candle near support or resistance on a weekly basis, and you've got a prediction for the next week that probabilities are more likely for the market to do a reversal or to realign itself with the previous trend, or simply finding it in trending markets is a great way to use this strategy as well. So let's jump back onto the charts, and I can kind of give you an example here on the New Zealand dollar Canadian dollar pair from the recent weeks. We're back on the chart. There's a great tool on TradingView. It's called MWD right here, MWD_XO_open, and that's created by Stingray T97. What this will do is you're able to plot the monthly open, the weekly open, and the daily open on your charts automatically without having to do really anything. So the benefit of this is we're just going to be using the weekly open, but you can also add the monthly open and the daily open for your own preference to kind of help you add additional confluence. For the purposes of this video, we're just going to be using the weekly open. So back on this day here, we had a low printed on the 20th of January before the market rallied higher, posting a high on the 31st around 0.912. And this low came in at 0.89, right around that level. So we had a little bit of a sell-off, and the market came in here on the week of February the 10th, okay? We had an open right around 89430. So when a market kind of closes near its lows and we get a little bit of a bounce, we can start looking for a potential bullish bias now that we are coming into those lows. All right, so in this case, if you had a bullish bias saying, all right, we're trading near the bottom of the range, we've seen a little bit of a reversal and I'm bullish on this week, but I don't really know where to get in. So what you can do is you can use the weekly open strategy for this kind of scenario. So what you'll see here is we've got the previous day low. What you'll want to do is mark out any obvious points of support and resistance. So in this case, we had this low sitting right in here, and that was a low that caused this rally. So that's a nice level of market structure there. There should be some buying in that level. And what you can see here is on the 10th, we had a nice little open, price bid up, and then it eventually moved down into this level, held that level, and broke back above the open. So once you see something like this, once you get that break back above the open, at this point, you are looking to anticipate dips as potential buying opportunities in this market. How you qualify them, that's up to your strategy, but that's essentially what you're gonna be using that weekly open for, is you're not buying it right on the weekly open. You're waiting for the accumulation to happen, which is this part right here. You can see the market opened here, the accumulation happened below the weekly open, and then once we got back above that weekly open, we never looked back until we got back up into the upside of the range. And I'll show you the bearish example within this market as well. But that's essentially what you're looking for. The weekly open, you're looking for support structure under the weekly open if you're bullish, and you're just simply waiting for the market to get below that weekly open, trade into that structure, show you that there's support there, and then once it gets back above the weekly open, you're looking to anticipate longs. All right, guys, so once we get that move back above the open, the market really shouldn't spend much time kind of consolidating around that level. It should move, where you're looking at the expansion phase of the weekly body. If you see that the market kind of dips under, trades back above, and then starts to flutter around and hold this level as support, you might just be in a consolidation market. So once you've got that weekly low in place, you can use it as a means to qualify longs, and the market really shouldn't get back under that low if that is in fact the true weekly low. So you've got somewhere where you can manage your risk off. If you're a day trader, you can trade this intraday. If you're a swing trader, you can use this to set your stops, and let's say if it gets back up here, you can set a buy stop in there, and you can set your stop loss below that level, so that if the market does trade back above that weekly open, your risk is under that low, and you're pretty much good to go to the upside. Alternatively, if you do see like this right here, we had a move back up into the upside. So the week after that happened, you saw we traded up into that level, held that resistance, kind of sold off here, and closed the week near these highs. So what is the new resistance level for us to look for? It's essentially this level right here, right? So what you see happens the next week is we got a move, we got the open just below that level, we had the bid step in, traded up into that resistance level, we found some resistance, held the weekly open as support, and then we had a push down under it. So what you really want to see when you're kind of using this strategy is you want to see a nice quick impulse move. Any small kind of breakouts that aren't very convincing, you kind of want to stay away from. If you see a nice clear volatile move right through that weekly open, that's usually your transition moment there. And once that happens, any retracements could be sold, in this case risking those weekly highs. So in this case, you saw market opened here, traded up into this resistance level, couldn't quite break it, then we broke below the open. We ended up retesting that open, as we mentioned, and then the market kind of continued lower from there, never trading back above these weekly highs. So that's kind of what you're looking for. And in this scenario now, this is this current week. This was the open here on the 24th of February. Again, we're in the middle of the range, so there's no real bias. But what you can see here is market opened up here. We had a nice run up back into this previous level of resistance, sold off from there, and we broke back below the open. So what you're looking for now is, this is technically what we would consider the weekly high. The weekly high should be in, and now we'd be looking to short rallies back up into that level. Ideally, we don't want to see it back above the weekly open. If it comes back in here and then rolls over, that's great. But for our purposes here, now that it's broken back under that weekly open, we're looking at short retracements and we can risk these highs. Now that may be a bit too high for day traders. Day traders can day trade around this move lower for the rest of the week. However, if you're a swing trader, you can now look to trade really any retracements and risking above the weekly highs here above this open. So I hope you guys enjoyed that. That's one of the strategies that we like to use here, especially when the market's trending and we don't really know where we're going to get in, but we have a bias for the week. So we plot the weekly open, plot our support and resistance levels above and below that level, and then we just wait for price to make its move, show us that sellers or buyers are holding that level, and then wait for the market to trade back under or back over the weekly open, and then we can trade the bias from there. So I hope you guys enjoyed that. If you did, please like and share this video with your friends. If you guys know anybody that has an interest in trading and wants to get started, but they don't know where, make sure to pass along our trading channel. So that's all for this week. Until next time, good luck and good trading, guys. Take care.